So what are credit spreads? Credit spreads is a defined loss and profit option strategy that involves simultaneously selling and buying an option on the same stock that expire at the same time. Two main types of credit spreads: put credit spreads and call credit spreads. Generally speaking, a put credit spread means you think that the stock is going to go up, and call credit spreads means you think the stock is going to go down. So let's just take a look first at a put credit spread with an example. Microsoft is currently trading around 380, and we think that Microsoft is either going to stay flat or go up in the short term. We have a bullish sentiment on the stock. And because of that bullish sentiment, we'll open up a put credit spread. In order to do that, remember, we have to buy and sell an option on the same stock that expire at the same time. So we'll start by selling an option below 380. For this example, we'll do 370. And then we'll buy an option below 370. In this case, let's just do 365. Now, because all options are time bound, we need to decide when we want those options to expire. Normally speaking, for myself, I like to do 30 days to expiry, but you can do any amount of time that is shown on the options chain. But in this example, we'll do 30 days out. When you're selling the Microsoft 370 put option, we'll actually receive $585 because we're selling an option, we'll receive money. Now, when I'm buying the Microsoft 365 put option, I'm going to be paying $435. So after that transaction, I'm actually going to end up receiving $150 after that credit spread is open. How do you make money or how do you lose money when selling a credit spread? Let's explore all three scenarios at the time of expiry. And we're going to first look at the best case scenario. And that would occur when Microsoft ends up above 370. In this case, for example, 375. The options that we bought and sold are both what we would call out of the money, which means that they would both expire worthless. Let's kind of explain why that is. For a sold option, we as the option seller has an obligation to buy 100 shares of Microsoft at that 370 price point. So if it's 375, why would someone want to sell it at 370 when you can literally go on the market and sell it at 375, right? You would make more money not going through with the option of selling it at 370. That's why the option is worth $0. For the option that we bought, we as the option buyer have an obligation to sell 100 shares of Microsoft at 365, which is the same reasoning. Why would I want to sell my Microsoft shares at 365 when I can sell them for 375 on the open market? Again, that's why the option would be worthless. And the profit that we make will be the $150 that we collected right when the credit spread was open 30 days ago. So the takeaway here is that the best case scenario, if the stock price were to be above both our sold and bought option, we would make the max profit, which would be the credit that we collected when we first initially opened the credit spread. This is pretty great, right? Because not only does Microsoft not have to go up, it can just not go down as much as you think it will, and you'll still win on the trade. Hence, in theory, why it should be more passive and you should have a better chance at winning more often. Next, we'll explore the worst case scenario, which is if Microsoft were to end up below 365, for example, 360, then the option that we bought and sold will both be what we call in the money, which means that we are going to have to fulfill our options obligation. Let's take a look at what that means for both the bought and sold options through the same lens as we did earlier. For the sold option, again, we have an obligation to buy 100 shares of Microsoft at 370. So even if it were at 350 or 355 or 360, we'll buy it at 370. Now for the bought option, we had an obligation to sell 100 shares of Microsoft at 365. If it's at 350, 355, 360, it doesn't matter. We'll sell 100 shares at 365. And this is why this is a defined loss strategy. After that transaction is complete, we will be buying 100 shares at 370. We will be selling 100 shares at 365, which is a $5 difference between the shares that we bought and the shares that we sold, times 100 shares, which means after all that transaction is complete, we will have lost $500. However, because we collected $150 originally when we first opened up the credit spread, our final loss will only be $350. This is a takeaway here, is in the worst case scenario, when you make max loss, the max loss will be quote unquote the width of the spread, which in this case will be 5 points because it's the top leg, which is 370, and the bottom leg, which is 365, is $5, which is 5 points, times 100 shares, which would be $500. We will then add the credit that we received, which is 150, so our max loss will be 350. The middle case scenario. What happens if Microsoft were to be between 370 and 365? 367 as an example. This means that the sold option is in the money, but the bought option is out of the money. We have an obligation now to buy 100 shares of Microsoft at 370, even though it's at 367. But because the bought option is out of the money, we don't have the obligation to sell that 100 shares at 365. With that 100 shares that we bought of Microsoft at 370, we can then sell it at 367 a share, resulting in a $300 loss from that transaction. And again, remember, we collected 150 to open up the spread, which means that we'll only lose $150 on this one trade. And you can see the same math play out when it's 368 or 369. 369 just means that we'll lose $100 when we sell it on the open market, but we'll make 150 on the credit, so we'll actually come up ahead with $50. Break-even points where the stock price is in order for you to break even on the trade. So in this case, the break-even will be $368.50 because we collected 150. If you lose 150 on the transaction of buying and selling the shares, then it will equal zero, and that will happen when the shares are at $368.50. Now, this is the tip here from myself. I usually don't let my credit spreads get to expiry if either leg ends up being in the money very, very close to expiry. I'll actually end up just closing the spread to not have to deal with the buying and selling transaction that has to occur. The math will work out to be basically the same. It saves you that anxiety. On the screen, you'll just see what we would like to call a P&L chart of a put credit spread. Basically, it shows you at what point you would make money and at what point you would lose money. Very similar to what you saw earlier. You make money when it's above your sold leg. You would lose the most money when it's below your bought option, and it's basically a linear line between your bought and sold option anytime the stock ends up somewhere in between those two price points. Test time. Here is another credit spread, and you tell me at the time of expiry the max loss and the max profit is, when they would occur, as well as the break-even point. On the screen, you'll see Apple 360, 350 put credit spread, expiry 45 days out. Let's assume here that we collected $250 off of opening this one credit spread. Feel free to pause the screen here and see if you guys can answer that question. Max profit will be $250. That will occur when Apple is above $360. Max loss will be $750 when Apple is below $350. The break-even point will be when Apple is at $357.50. If you guys understood that, if you guys got that right, then you guys basically understand how put credit spreads work. So now let's talk about the call credit spread. We're going to use Microsoft again. Microsoft, as a reminder, is currently sitting at 380. Unlike the previous example, we now think that Microsoft's either going to stay flat or go down. We have a bearish sentiment. So in that case, we'll open up a call credit spread. In order to do that, we have to sell an option above 380. Let's just say 390. And then we'll buy an option above 390. In this case, let's do 395. And just to make things different, we'll say 23 days to expiry. When we sell the Microsoft 390, we're actually collecting $585. When we buy the Microsoft 395 option, we are paying $435. Again, a 5-point spread. And the credit collected this time in this example is also going to be $150. Now let's do the same profit and loss exercise, but for the call side. But here's a curveball. We're gonna do the pop quiz first. What is the max profit? And at what price point does Microsoft have to be for that to occur? What is the max loss? And when does that occur? And the last one, what does Microsoft have to be at for us to break even? Feel free to pause the screen here and think through it. But here are the answers. For the first one, what is the max profit and when does that occur? If Microsoft is below 390, the bottom leg, then both options will expire out of the money and we'll take our max profit at $150. Max loss will occur if Microsoft goes above our top leg, which is 395. Then both options will expire in the money and our max loss will be $350. The width is 5 times 100, which is 500 minus the 150 that we collected, therefore 350. We will break even when Microsoft ends up at $391.50. Here's what the P&L graph will look like. Feel free to pause if you need a couple seconds to digest it. The math works out to be basically the same as a put credit spread. The only difference is on which side of the trade you want to be on, whether or not you're bullish or bearish. What happens during the time when you open it and the time of expiry, right? What happens if the stock price were to move up or down? in relation to your credit spread, either whether it's a call or a put, and how does your credit spread pricing change? So we're going to take a look at that now using Microsoft again. This is the Microsoft stock price from June 12th to July 8th. You can see it started at 327.89. It peaked at 348.72 on June 16th. And then it closed at 341.27 on July 7th. We're going to correlate the stock price to both a put credit spread and a call credit spread. We'll open up a 320, 315 put credit spread and a 340, 345 call credit spread. We'll start with the put credit spread first. So on June 12th, we opened up a 320, 315 put credit spread, collected $111. So as Microsoft moves up, the put credit spread will lose value. And this is a good thing for us because we want it to lose value. The max profit that we can get is when the put credit spread gets to 0. And so on June 16th, when Microsoft peaked at 348.72, the put credit spread is actually worth only $25. So at this point in time, if you were to close this credit spread, you would spend $25 to close it. But remember, you collected $111, which means that you would actually make $86. Microsoft gradually came down again, and it got to a quote-unquote low of 332.87 on June 27th. At this point in time, your put credit spread is still only worth $49. So if you were to close here, you would actually still make $62 on this trade. And this is what I personally love about credit spreads is because it's you're selling an option, time is actually in your favor. This is what you'll hear called theta decay or time decay. I made a whole video about theta that you might want to check out if you're interested. But a TLDR, as time goes on, your option becomes worth less and less, even if the stock price stays in the same exact price point. Now, because on June 27th, Microsoft is only $4 higher than June 12th, you can see time decay, theta decay really kick in. Because of that, your options are worth less. The market subsequently moved up, and so you can see on expiry, July 7th, your put credit spread is 0. So this is a very simple trade. The market moved in your direction immediately. Let's flip over to the call side, right? You can see that markets went up. So if you opened up a 340, 345 call credit spread, you can probably already assume you'll probably lose money immediately after you opened it. And you would be correct. You can see on June 12th, when I opened it for 102, immediately after on June 16th, when it peaked at 348.72, your credit spread's already worth $320. So if you were to close it at this very moment, you will incur a loss of $218. Now, because the market starts going down again, you can see your call credit spread pricing starts to subsequently drop. And on June 27th, the same date when it hits that 332.87, the subsequent low, you can see this is the perfect example of how theta comes in. Even though you're $4 above where it was before when you opened it on June 12th, your call credit spread is only worth $99. Right? Remember, you opened it at 102. So if you close it at this point in time, you will make $3. Even though Microsoft is up 4 points, close to 5 points. Right? That's pretty cool because you don't necessarily have to be correct in direction. The market just has to move less than what you are anticipating it to move. And then the time of expiry at July 7th close, Microsoft is actually at 341.27. So because your bottom leg is in the money, but your top leg is out of the money, your credit spread will cost you $127 because you're $1.27 in the money. If you were to let it expire, you would actually only lose $25 on this trade. Microsoft went against you, right? You were betting bearish, but Microsoft was bullish. One takeaway here is you can see the pricing of the call credit spread is very similar to the price of Microsoft. So that's generally how credit spreads are priced. Theta comes in and helps you a lot. Generally speaking, as long as you're quote unquote directionally correct, you'll end up making money. And this is why credit spreads are a higher probability win strategy. The last thing I'm going to go through here is walking you through an example on how to open up a credit spread. So there's two things that we have to answer. Which direction are we going to sell in? Are we going to sell a put or a call credit spread? And number two, what price point are we selling our credit spread at? So I want to use Amazon as an example. And so I want to start by first understanding what the trend of the market is. And there's a saying, the trend is your friend, and we want to follow the trend. And so when we look at this chart, and this is a daily chart on Amazon, we can see that Amazon has been in an uptrend. Why is that? Because you can see that Amazon was at $89, right, way back in March, but now in January, we're at $154. Another way to tell is you can see it goes from a low to a high, to a higher low, to a higher high, to a higher low, to a higher high, to a low, and then it formed another higher high. It's in an uptrend. So in this case, we want to trade the trend, which means that we want to trade bullish. And that means that we will have to sell a put credit spread to take advantage of the trend. Now that we've determined that, the second question comes into play. What price point are we going to sell this credit spread at? I like to trade off of price action and supports and resistances. Other people may sell off of delta, and you guys feel free to check out those videos, but that's not how I like to trade personally. One thing we like to understand here, levels of supports and resistances. Supports and resistances at a high level basically just means areas where sellers sell and buyers buy. So you can see right here, we can draw a line here, right at this level, that market came up here, fell off, came up here, fell off, right? That's a level of resistance. This is a level of support because the market came down here and then it bounced up, right? So that's a level of support. Hit it once, bounced up, hit it twice, but bounce all the way up. There's this idea where an area of resistance could theoretically become an area of support, right? What that means is sellers sold here. However, the buyers pushed it up to a point where when it comes back, as you see right here, if buyers step in and push it up, this is now the new support, similar to what you see right here, right? So what we're going to do here is we're going to see whether or not the market is going to respect this level, right? I'll draw this a little bit closer. It's going to respect this level. And on the next day, it doesn't. And then the following day, it does. So on this candle right here, I would be like, yeah, the market actually does seem to be respecting this level as an area of support. The buyer seems to have stepped in on January 8th, and then we're going to determine at what level we want to sell at. So this is my strategy. Feel free to change it. I like to use something called ATR. It's the average true range. I won't go too much into it, but basically what that means is the average movement within a 14-day period. Amazon's sitting around 3, so I like to do 1 ATR. So if the support's at 144, then I'm going to be selling it at 140, right? So what we're going to do here, we're going to go to trade, and we're going to Amazon. We're going to collapse this and go 32 days out. I like to sell for a month, but you can sell any time here, right? But for monthly passive income, I like to do a month. So go to 32 days out. And here, make sure that this is on vertical. Vertical is the same thing as a credit spread. We're going to try and find the 140 strike. So I found the 140, 139. You can leave it as a 1-point spread, but you can come in here and change it. So for example, let's change it to a 5-point spread, okay? Which means that my top leg, the sold put, is 140. The one that I'm buying is at 135. So let's go back to the chart. It'll be at 140 right here and then 135. So as long as Amazon doesn't dip past 140, I make max profit. If Amazon dips past 135, which would be down here, then I lose max loss. The credit that I receive will be $114, so that's my max profit. My max loss in this case will be $386. So let me know down in the comment section below if you guys have any questions. This could take a couple times for you guys to walk through this video and understand all the detail, especially if you're new to credit spreads. If you guys want to see another example of how I use credit spreads to generate 60% return a month, make sure you guys click this video linked in the end screen right here. If you guys learned something, if you guys like this type of content, please press that thumbs up button and consider subscribing. It'll really help the channel out. And until next time, stay safe in the market. Peace.